Jack, what about you?
I think, first of all, you have to draw a distinction between the environment in Europe and the environment in the United States. You know, to Brian's point, there is more room to run when it comes to the ECB hiking, but I think it's important to point out that there are very clear disinflationary signs here in the U.S. You can't really necessarily say the same thing over in Europe, at least not just yet, which means that investors in the States, I think, are desperate to look for some sort of signal that the Fed is almost done. There is so much fatigue here. So while a 50 basis point hike might have been necessary over in Europe from the ECB, I can't really comment on that. I would say that if the Fed decided to not go to 50 basis points or not even go 25 basis points, that would be met with, I think, some sighs of relief.
There are some people who believe this is just the beginning. I caught up with your colleague, Bob Michael, earlier in the week. He said, tip of the iceberg. Jack, how do you see this flowing through asset classes now from here?
I mean, when it comes down to the positioning in asset classes, I do think the story is still all about what Fed implications are. And at the end of the day, John, to me, financial stability is more important than inflation. And the Fed's going to have an awfully hard time transmitting monetary policy through a banking system that it's broken. And so I do think that we're probably going to see some sort of reprieve next week when it comes to that hiking cycle. I do think we're also going to get some signals that the end is pretty darn near if next week isn't in and of itself the end of this hiking cycle. Net, I think that's pretty decent for longer-term, growthier risk assets that are going to be able to look through perhaps the next few months of volatility, perhaps even a recession, and see a terminal rate that is lower than expected and getting there a little bit faster than expected.